I'm market analyst Michael Filighera of Traders Helping Traders with the Eye of the Storm podcast, helping you make informed trading decisions for the week ahead. And good day, everybody. Welcome to this week's edition of the Eye of the Storm podcast, again with my guest, Dan Ascani, who likely is not so much a guest as much as he is a regular. And it's something that we both really enjoy. We always have had wonderful conversations when it comes to the market and our analysis and what we think, and those continued. And so what we both have kind of come up with is like, we might as well attempt to bring this to a wider audience, do it as a podcast, but in our attempt to go behind the curtain to bring in additional information, or what we would perceive as what's truth, what really is happening behind the curtain, it ends up just being a very informative conversation between two traders and analysts. And so I think there'll be great benefit to that. But today, I'm going to be talking, or we're going to be discussing Dan's latest blog post, which will be available and on defendingyourmoney.com. And the working title to the actual title that Dan is using is something different, but I'm going to let him fill in that blank. So basically what we're going to be talking about today is titled Structural Changes Within the Economy Call for Much More Than Rising Interest Rates to Cure Embedded Inflation. Now that's a great title of a very in-depth report, basically, even though it's being listed as a blog post. And as you both, through these podcasts, but also through my daily work, just my Elliott Wave updates, I have brought great attention to expiration cycles being every single day in the indices and also in several of the treasury markets, and that weekly options expirations for all of the component companies, corporations within our indices, and how and what effect that has had on not only an Elliott Wave count, but just in a market moving through a normal cycle. So we've seen a lot of disruptions. And this past week, we noticed that it's like, wow, we've got the bond market beginning to slide lower again. We've got the Fed funds heading towards 5 to 5.25%. And the equity markets are deciding to ignore that. Now, that poses a lot of questions, and we are trying to understand. So Dan did some deep digging and went around. And so I'm going to basically turn this over to Dan so he can begin to report on his findings in his latest blog post. So again, welcome, Dan. Thank you again for coming on today with me. And I am just going to turn it over to you so that you can go ahead and begin to tell us what it's all about.
Well, first of all, thanks for having me, Michael. And, I've got to say that there's a lot of things going on, obviously, but, I've entitled this blog post, Myopic Wall Street's Constant Fixation on the Fed is Headed for a Tearful Ending. That sounds kind of doomsday-ish, but, hey, what's happening is investors are being myopic again. What that means is they're overly focused on the short term. If you look at the way the market is, and you look at some of the articles now beginning to emerge on financial media, which I've seen over the last few days, there's more attention being brought to how the market is, how the equity market is maybe the only asset class that hasn't gotten it yet, so to speak. So the Fed is combating inflation. It's slowed a little bit, but it's got a long way to go to the Fed's target.
Yes.
Inflation is embedded in the economy, and bonds have gotten it. They've begun to adjust to the so-called new reality here. Commodities and gold have gotten it. The dollar's gotten it. So the other three asset classes have gotten it. But if you look at intermarket relationships, there's something wrong here. Normally the stock market would be also down more than it is. So you could make a case that the equity market has not gotten it yet. And by gotten it, I mean the fact that not only is the Fed needing to raise rates for I shouldn't say a long time, for some time to come, or at least keep them high for some time to come, but there's an over focus, an intense focus on the very short term. I think you alluded to this, and you've been doing it on your own updates, and that is there are so many option expirations now. There's so many reasons to focus on daily short-term moves in the market.
Yes.
And there's been kind of a reluctance to accept the market maybe declining more, that everyone's focused on intraday or single day activities, so that the market is just not getting it, so to speak. And so if you're listening to this, you're probably thinking, wow, he must be really thinking the market should go down a lot. Well, looking at intermarket relationships between the asset classes I just mentioned, maybe the stock market should, but I'm not going to go there right now too heavily. I'm going to say that the market's been a little bit myopic, and that inflation is not only here to stay, but the part of the purpose of the blog post is to point out that there's more over the long term that's needed to solve the inflation problem long term.
Mm-hmm.
It's not just a situation like the equity market seems to be hoping for, where the Fed raises rates for a while, maybe even a year, like it's been almost, and then inflation's come down and we can get back to the old game. It's almost like the equity market and players want to just bid the market through the roof again, go back up to record highs and act like nothing ever happened. And that's not the case.
Right.
Michael, as you know, there was a sea change in 2022.
Right.
Not only did the Fed start to raise rates fairly early in the year, but we also had, as everyone knows, the invasion of Ukraine by Russia. And that reestablished a Cold War environment that's been getting worse as we've gone through this last year. At first, it was like, oh no, another Cold War environment. Now it's like, okay, there's a Cold War environment. And there's also a situation in which corporations in the US are reevaluating the risk associated with the moves to offshore manufacturing that occurred over the last few decades. That can be referred to as globalization. Basically about 30 years ago, they started to take advantage of lower labor costs and opening plants and locations in other countries.
And how many years has that been now? Has it been 10? Has it been 10 years or more?
Since globalization?
The globalization. But when we saw everybody's help center, everybody's customer support folks moving offshore, being over in foreign land, so to speak.
The help centers, I'm not sure. That could be 10 years or so, but the move toward globalization actually was occurring after the collapse of the Soviet Union in 1989 to 1991. At that time, Russia actually became friendly, and Ukraine and the Baltic states and various Eastern European countries declared their independence, and everything seemed to be going in that direction, but not now. Now it's a whole different story. So about 30 years later, which is now, deglobalization is occurring. What that means is that corporations are reevaluating the risk of having those manufacturing plants and so forth, those locations offshore. Everyone knows that when Russia invaded Ukraine, shortly thereafter, many corporations closed down their locations in Russia.
Right.
And then we've got the situation in which, this is unfortunate, but China possibly invading Taiwan is hovering over us.
Yeah.
And Taiwan is the biggest producer of semiconductors in the world. And now we're seeing corporations, including Apple, for example, reevaluating whether they want to keep producing those semiconductors offshore. So there's more of a pull towards, maybe we should produce this in America. The extent of that remains to be seen, but maybe, there'll be a lot more production in the United States to lower risk associated with what used to be globalization.
I agree with that, and you brought an excellent example, and that is that China, even on mainland China, Apple has large plants in southern. I don't remember exactly which province it is, but they have where the iPhones are being produced and put together. is on mainland China. And they ran into disruptions with the iPhone 14 based on the fact that China had such a strict COVID policy. They shut the country down again, and people couldn't go to work, and therefore we couldn't get the parts or the phones out of the country and over here for delivery. So I agree with you, and I know because I've also read where from the top down, so from Tim Cook down, they're having discussions on what do we need to do if, and exactly as you said, if China decides that they're going to go retake Taiwan, or they're going to really put a disruption into place where the chips necessary to produce all of our electronics, which basically, folks, if you think about it now, it's everything. It's everything.
Including semiconductors needed for missiles.
For everything. I mean, there's the military application, but then there's just us, the retail people, right? Us retails folks, where are electronics used? Everywhere in our homes, everywhere. We now call it smart home. We have smart homes, smart doorbells, smart this, smart car, smartphones. Everything's smart. Well, it all comes because the chips keep getting smaller because they keep getting smarter on how they're going to make the chips. What happens when they can't do that? What kind of disruption will it be for our economy? And this is part of what I believe your statement, the myopic, is really kind of coming from. Because I think today's market players are myopic in that they don't see the potential. What could happen if China decides, no more, we're not exporting out of Taiwan, we're taking Taiwan over? And I do really feel that they could do it without firing a shot. Now, what happens if that happens? It's like, the United States has promised to come and defend Taiwan. Don't worry. What if they go in without a shot being fired? It's like, you're ours. Either you're going to do it or you're not, but we're going to surround your nice little island and nothing's going to get in and out. I don't know. But when we start to look at the possibilities, they do present a much different picture that I do not believe, like you are mentioning, that the markets are looking at. They just see the constant inflow. They don't see how it gets here.
Right. So for years after the collapse of 2008, 2009, which was a failure of the financial system and a crash of the equity market, housing market, et cetera, for years after that, we had a Fed policy of zero interest rates, ZIRP, zero interest rate policy,
right?
Where the Fed controlled interest rates were at zero or plus or minus 0.25%. And that went on for years. If you count it, it's probably 13 years, where we had zero interest rate policy until 2022.
Right.
So equity players, money managers, everyone got used to basically free money. What that did was it produced what's called a carry trade. That means borrow at low interest, in this case, virtually zero, and invest that money in something that yields a return. That's the carry trade has been common in the currency markets for many years, and it kind of bled over to the stock market. So the Fed with zero interest rate policy, or ZIRP, provided free money basically to institutions who could get a hold of that money, and then they invested that in the stock market. And then the Fed was supporting the markets, buying bonds, mortgage backs, et cetera. And so there was a whole era of a Fed put, so to speak. If the market dropped or began to collapse again, the Fed would support it.
Right.
And so players got used to that for many years. And then all of a sudden you come to 2022. I shouldn't say all of a sudden you come to 22. Now 2022, all of a sudden, there's a sea change. Russia invades Ukraine toward the beginning of the year. The Fed's starting to raise rates. Inflation is beginning to take off. The economy is reopening. Now you have a sea change. You have a situation in which zero interest rate policy really effectively doesn't belong anymore. And so the Fed raising rates actually fairly aggressively, but it took them a while to get it off zero toward, where it is now, to the point where it's producing at this time, a 6-month treasury bill rate of around 5%.
Right.
So you not only have a sea change, but you also have a situation in which treasuries or fixed income competes with equity returns, or at least expected equity returns. So you're looking at the situation in which Wall Street money managers would put into their models maybe an expectation that fixed income provides a return too, and then it may be, in terms of a 6-month bill, 5% or close to it. And so now you have competition from the fixed income market, but yet the bond market, fixed income market, continues to drop. That is, bond prices, 10-year treasury note prices continue to drop. And since interest rates are inversely related to prices, as interest rates rise, bond prices drop, and that actually produces even more competition to the equity market. So I think the main point here is 2022 was a sea change. Yet, I want to say Wall Street, just for lack of a better term, Wall Street continues to focus on the game that was underway of zero interest rate, the carry trade, et cetera.
Right. I think that is important.
Right. It seems to be refusing to acknowledge that this is going to be here for a while. This is not going to be solved anytime soon. And even if the Fed were to magically solve inflation tomorrow, we still have a new Cold War environment. We have a situation in which there's a massive restructuring in the economy that's beginning to occur.
Right.
And that is a reversal of the trend from globalization to deglobalization, which I can explain more of as we go through this broadcast.
I like the conversation about the carry trade, because I think people within the equity side of this, our markets, maybe don't have a clear understanding. And I liked your explanation, was really good. But that was a huge moneymaker. That was a huge moneymaker for corporations, for the banking system, for the banks, for big trading firms. It was the carry trade, and that's what got put on and carried forward for 13 years, because it was pretty much a given that interest rates were going to remain fixed almost, or held artificially low. Now, I think part of what happens during that period is that we, again, the retail, and many times even on the corporate level, because those are retail people just working at a corporate level, that they forget that the longer you carry this on and deliberately hold interest rates low, how tight can you wind that spring before it's going to go, before you're ready for it to go, and it just goes boom, and we get this massive problem. And I think that's basically by their ignoring that the change is coming, ignoring that we need to adhere to this change or be prepared for this change, is tightening a spring. And if we think about that in terms of what the equity markets can look like, I want people to just really get an understanding that you can tighten, and then finally, when it breaks, you're going to get a move that you're truly not expecting.
Exactly. So let's focus on that carry trade for a second, because
yes, please.
It sounds a little complex if you're not used to that term, but don't overly worry about it. What it is it's really the cause, or at least the background environment for the crashes that we keep happening.
Yes.
In the equity market.
Yeah.
Anyone ever wondered why we have crashes more frequently now? I mean, it used to be every 50 or 60 years we might have a crash, which still seemed kind of frequent. But we've had crashes every few years now. The 1987 crash, then the 2002 collapse in equity prices. It's debatable whether that was a crash or not, but 2008 was. The COVID crash of 2020 was. Why are we having crashes every 5, 10, 13, 14 years? So that's where the carry trade comes into play. So, and the Fed, by the way, is the biggest enabler of the carry trade. So by dropping rates to zero or close to it, zero plus or minus a quarter, the Fed is giving institutions free money, and they're taking that money and doing something with it. What do? They're trying to get a return on it. So as soon as you borrow at close to zero and invest in something that's giving you a return, especially with the Fed supporting the market since the 2008 crash, you've got a winner there. However, now enter the new normal, or another version of the new normal, and that's with interest rates jacked up rapidly to the point where, as I said, the most recent 6-month Treasury bill rate is 5%, 5.02 plus or minus.
Right.
So now you have the carry trade almost getting totally busted here. So now you can't borrow at zero. You have to borrow at some higher rate, and now that means there's got to be an acceptance of the cost of borrowing money is higher. So now there's more risk borrowing at, let's say, 4 or 5%.
So does it make sense then that people should understand what you're explaining is that edge, that profit that they were looking for, or the ability to pull the profit because interest rates were at basically zero. You borrow at zero, you're putting on positions where you're going to get 4 or 5%. Wow, nice trade. Now again, interest rates are going up. You've got to go find something that if you're going to have to be paying 4 or 5% for the money that you need to borrow, what kind of return do you get? Well, they're still expecting the same type of return because they don't see how this all is going to affect the bottom line of Apple, of Amazon, of Google, of Tesla, of all of our big tech companies, all of our major corporations. They just don't see, including, and I'm going to say including JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America, Wells Fargo, our big, too big to fail banks who made a bloody fortune, billions, if not trillions of dollars, folks, on this carry trade. What happens if they can't get out? What happens if now they're in it? So again, you make a very good, massive economic changes beginning, and Wall Street needs to pay attention. Do we think that at some level within all of these companies, with all of our banks, they are paying attention, but they have no idea what they need to do?
Well, I think, let's wrap up the carry trade part a little bit here, and then we'll move on because there's more going on here. But the point is, if the carry trade, which was so profitable after the crash when the Fed was supporting the market and dropped rates to zero, you could borrow at close to zero. Mm-hmm. And if your expected return in the equity market is 5 or 10%, that's a winner. You borrow at zero or close to it, you make 5 or 10. That's worth it. But now the equation changed in 2022, a sea change, as I mentioned. Now you borrow at maybe, let's say, 4 or 5%. Now suddenly, if your expected return in the market is 5 or 10%, now there's a chance you might only break even. Or with the rising interest rate environment, the new Cold War, and other things going on, the deglobalization we're just talking about, now all of a sudden, do your models say that your expected return is 5% or 10? Maybe it's not. Maybe the carry trade is now break even. Maybe you borrow at 5 and you'll be lucky to make 5. Or maybe the market's down like it was in 2022 in a bear market with negative returns. Now you've got an inverse situation where you've borrowed and can't even make that return. So the carry trade is important. That's been part of the cause of crashes that we've been having. When I want to say institutions, that's for lack of a better word, when players are in this carry trade and suddenly everything changes, like the COVID lockdown, for example, all of a sudden the economy is locked down and the market's collapsing. Now all of a sudden everyone's trying to unwind their carry trade. They got to get out of this. There's margin calls, there's whatever else going on. They've got to get out of this trade. And then the market and the selling begets selling, so the market just ends up going down. So that's the carry trade part, and that's very important because that's helped contribute to crashes that we've had in the equity market, and could even contribute to another one if we get another unwinding of that carry trade. But then when you go forward to what you and I were starting to touch on, which partly is deglobalization, where corporations, at the same time all this is happening that you and I are talking about, not to mention the Russian invasion of Ukraine, but when they're taking a look at, is it worth the risk of offshoring my manufacturing? Let's say you're Apple and you're offshoring the manufacturing of semiconductors and iPhones to China and Taiwan. Is it worth the the risk of offshoring that production when you might suddenly get cut off. You might not only have supply chain problems like we've had since the COVID reopening, but there might be a geopolitical situation in which your supplies are cut off completely, or China decides to retaliate in this Cold War environment against the United States by shutting down Apple plants. I mean, I'm just throwing things out there, but these are extreme situations that could happen. So the point is, whether that happens or not, corporations like Apple and so forth are now saying, maybe it's not worth lower cost of offshoring. Maybe I should produce some of this in the United States, which, you know, people tend to want anyway, made in America. So now they're looking more toward onshoring, you know, bringing back production here.
Right.
Deglobalization means the trend toward using the whole globe as a trade environment and as a manufacturing arena, almost as if it's one environment. Now that's reversing. And so in addition to the carry trade getting busted here, or at least, you know, being less potentially profitable for those engaged in it, now you've got the onshoring and the deglobalization. And that's really part of the sea change that I cover in the blog that, you know, we're talking about right now.
Right. And so with that in mind, why do you think that the financial markets are giving the Fed a headache?
Partly because the Fed has said in its messaging, and that messaging is important because the Fed keeps delivering that messaging, saying, look, we're going to have rates high for a long time, and the market hasn't seemed to want to accept that.
Right.
So the Fed messaging is hawkish. So, but yet when the market goes up like it just did, let's say 2023 starts, we've got a 10% rally in the NASDAQ in January, I believe it was, and something similar, you know, close to it in the S&P 500. You've got this big rally that's happened. So that's in effect an easing of financial conditions by the markets themselves that the Fed doesn't necessarily want.
Right.
So the markets can actually, by going up a lot like that, can erase part of the Fed's tightening that it's trying to do to combat inflation. So when the market goes up, the Fed kind of tries to combat that, and it refers to it kind of subtly in its press releases and its Federal Open Market Committee minutes.
Right.
You know, it kind of addresses that by saying, hey, the easing of financial conditions or whatever. I forgot how they exactly worded it, but the unintended easing of financial conditions, you know, basically that's referring to the market easing on its own accord. Because when the market goes up, when equities go up, or let's say all the financial markets go up, that's actually adding wealth to people. And the Fed's trying to slow demand. It's trying to slow the economy, maybe even to the point of recession. When the market goes up, it's actually giving people more wealth, or at least recovering some of the wealth that was taken away in the 2022 bear market to date so far. So the Fed really doesn't want that to happen. So that's why the markets are giving the Fed a headache. The Fed really doesn't want this to happen. It's not like the Fed doesn't want the market to go up. It's just that if it goes up a lot, it's going to erase some of the tightening the Fed has been doing, and it's going to require the Fed to tighten even more to get rid of inflation.
Good point. And I agree with everything that you've just added. One thing that I kind of have thought about is that the asset managers now, the portfolio managers, the younger people that are younger people, it's because I am as old as I am, but just the folks that are now in charge of hedge funds, producing the hedge funds, coming into the market with the hedge funds, et cetera, et cetera. They're basing all of their decision making on models that are usually proprietary, but I'm beginning to feel that it's like their unwillingness to actually believe what the Fed is saying has a couple of reasons. One, because their models might have a slight flaw to how they're all projecting out and what they seem to think they're taking enough information in to produce the model. And the second thing is that we have touched on before, but I want to touch on it again because I want people to truly understand. For example, last Wednesday, So 3 days before our expiration Friday, which we already knew was being that the prices were going to be jacked around and moved around and pushed around based on where players and large firms needed to have that expiration. But prior to that, against a market that was going down, we're all looking over and like, why is VIX going to 18? Why isn't VIX really at 21 or 22 and continuing to walk itself higher? We've got the bond market reacting to what the Fed is saying. We've got this happening. We're seeing the Fed funds goes up, and here the market's going to go, okay, we're going down to 18 here. I was like, it just seemed, and I'm going to use the word, and please forgive me, folks, ass backwards. It just seemed like it was totally in reverse of what reality was telling us what we should expect. But then I came to realize, and I believe it's because you and I were talking on Wednesday or Tuesday, and we realized that, wait a minute, there's a big vol expiration on Wednesday. And it seems to me that what all these, and the volatility indexes and all of those derivatives, folks, are available for all of us to trade, but they're really the big boys game place. That's where they're really coming in with large amounts of money and putting it there. And because they need to, based on where they think the market's going to be and how all this is going to work out. Now, it may seem convoluted because it kind of is, but at the same time, there are, when I have gone to put out to show VIX, you can put VIX in your screen like I use Thinkorswim, and I put it there, and it gives me 7 different choices of all the different variables, all the different derivative markets that have been now all based on the CBOE volatility index, which has been around forever. Well, for me, it feels like forever. Now, let's talk about that and put that into this whole equation about why the Fed's really, why the financial markets are giving a Fed a headache, and why Wall Street, for the lack of the better word, is not paying attention to what the Fed is actually saying. I still believe that a great deal of it is because of the way exchanges have continued to add derivative products and their expirations.
Yes. So there's a couple of things going on here. First of all, when the bear market set out and institutions and investors buy put options, put options, a form of insurance on portfolios. So you can hold your stock portfolio, buy put options, which are designed to go up when the market or the underlying goes down. That didn't work last year. There were too many rallies, too much of a choppy type of decline, for lack of any other way to explain it, for put options to work. So you went through the whole 2022 decline where the put options really didn't provide enough profits to offset the market's decline. So you're getting kind of less, you've had less activity in put options than if they would have worked. Secondly, what you just alluded to, the exchanges have come out with 0 DTE options, 0 days to expiration, DTE options. There were, let's take an example, the SPX or the ES, the E-mini futures, Monday, Wednesday, Friday expirations. The exchange filled them in with Tuesday, Thursday. Now you have options expiring every day.
Yes.
That may not even exist for more than 24 hours. So you have institutions and investors that may come in, let's say on a Tuesday morning, or actually beginning in the Globex session in the futures market on Monday night, just as an example. They can buy an option expiring before tomorrow's close. By the time it expires, the market's closed on that day, and then that option's out of here. So what that's doing is causing flows in the markets, both in terms of investors and in terms of dealer hedging. Market makers making a market in those 0 DTE options. It's causing flows that are, I'm trying to think of a good word to explain it, choppy or so short-term focused that there's no thinking about the things you and I are talking about, deglobalization, onshoring, all that stuff, the Cold War. If you're in a 0 DTE option that expires in less than 24 hours, you're not worried about a Cold War, or you're worried about a little bit of headline risk, but you're not really worried about a Cold War or onshoring. That seems more of a long-term trend, but that's basically the definition of myopic investors.
Right.
Myopic investors being those focus so much on the short term that they're disregarding the longer term, or in this case, maybe the intermediate term. So all those factors are contributing to an environment in which the equity market opens on any one day recently, and you've got fluctuations in it that seem disconnected from everything else that's going on, including rising interest rates and embedded inflation and so forth.
I agree. I agree totally with that statement. That we both are day traders. We also have positions, but we're both basically day traders, Monday through Friday while the markets are open. And you are absolutely 100% correct that sometimes you're just looking, going like, what are they thinking? And it has, as I try to tell people in my trade room, and I tell people through, my updates, many of these market moves have nothing to do with the player or the person initiating it or the company initiating it or feeding into it, have suddenly turned bullish and or bearish. So I tend to have dropped those words from how I present something, because in essence, it truly is it's happening. It's that we're not in a bull market. We're not in a bear market. We're in a market that just moves on its own volition and on its own thought at that moment. And that could be a zero DTE option expiring. It could be the Friday expiration. It could be a number of things. Now, when you add into that now we have earnings reports, and we still have some more major companies that are going to be reporting this week. And so we still got the earnings season upon us. And then if it's not that, it's going to be, well, now we're looking towards this week. We have last week had CPI, this week we have PPI. Okay, well, now we got to wait for that figure. It's like, that is the part that I believe, folks, is going to have to change. We can't just flow from a number to number thinking that's going to be the catalyst that's going to drive it. So in my opinion, and then I do want to kind of go on a little bit more with what we're talking about, that when we're trying to determine, what's going to be the catalyst that's going to drive the market to drop, particularly let's say in the S&P 150 or 200 points, go into crash mode, that we're going to see the NASDAQ down 5 or 6 or 7 or 800 NASDAQ points. And people say, well, that's not possible. It's like, yeah, it is. And all you have to do is go back a little bit and you will see when it occurred. And you will determine what, if you have a good enough memory, what triggered that. And most often it is the CPI or the PPI or the Fed itself. And the Fed can produce tail spinners, man. And the Fed can just come out and just ruin your week or your day or your month. And that's the point that Dan is making here, that we have a sincere, and I'm going to use the correct term, what we have an absence of at the moment are macro traders. These are the firms, these are the traders, the large firms, the hedge funds, that their job, what they go off of, are the economic data, is what they now believe how they need to position moving forward. But they're not, because, as you just so aptly described, we just were walking through a period where putting puts and being prepared didn't work, because the market constantly is being, can't go, not going to go, got to go up, not going to do that, got to go here. And so I think it just, even those traders get to a point where it's like, I toss it up. I don't know. So they're coming up with different positions that they want to put on. So I don't know if there's a particular way to deal with it, but talk a little bit about the disappearance of the macro traders. I'll give you my one thought that I thought. All right. And then because I wanted to include this actually, so that you could respond to the whole ball of wax that I'm going to talk about. And if you remember, about a week ago, maybe two, where suddenly we saw this influx of money come in because of the AI, artificial intelligence, GPT, whatever they're called, that Microsoft, made a $13 billion investment into that firm.
Chat GPT.
Yeah. Yes. And then suddenly we're starting to see that, well, we're seeing anything that has artificial intelligence start to get money put in. So I'm thinking that the macro traders who are hedge funds and portfolio managers, et cetera, they didn't want to get caught behind the curveball, so to speak, or be late. So they went in and they put all their money in, what they felt that they needed to get in to start a position or keep a position, et cetera. So, because what did we see? We saw Tesla, we saw Microsoft, we saw Apple, we saw Google, anything that has AI, Amazon, all suddenly come to life and jump. Now, are they early? Yeah, more than likely. But if these are the macro traders that were looking to come in and position themselves for a down market, and they've just come in and spent 50, 100, 150 million or 200 million or however many millions of dollars they just stuck into these stocks, do you think they're between a rock and a hard place? Because now they're like, well, are we early? Do we need to get out? Or should I just be putting on puts anyway?
Well, I think with respect to the macro trader, macro being, the macroeconomic look, the bigger picture look, hey, the Fed's raising rates and inflation is whatever, and GDP is going to be this and that, so I'm going to buy or I'm going to sell. That's that kind of decision versus another situation which an options dealer, for example, based on the structure, has to automatically hedge the hedge book based on what's going on in the market. Two different types of situations. But the macro trader or investor, I think, has a challenge here because everyone pretty much knows that the market's going to have trouble going up with the Fed raising rates. The old adage, don't fight the Fed. So the Fed's still raising rates. It's saying inflation is not under control yet. Rates are going to be high. In fact, you look at what the Fed's messaging is, it looks like they're going higher still from where they are now. It's difficult for the market to bottom and stage a sustainable rally or advance bull market nonetheless, with this environment. So the macro investor is, I don't want to say absent, but just not that prominent. So what that means is volume is less than it would normally be. And so it's more subject on a day-to-day basis to other things happening, like dealer hedging from the option structure or from short-term trading, like you and I were just talking about, based on zero DTE, 0 days to expiration options. And that kind of thing is really kind of bifurcated the market between what it used to be, investors and I want to say macro traders, coming in and buying dips. And that's not happening as much with the Fed raising rates. So basically we're at that point now where the many people, I think, are sitting here going, when's the Fed going to be done? I want to come in and buy, and that's part of the myopia here. It's like that's not all there is to it. What I cover in the blog that we're talking about is it's going to take more than just higher rates to cure inflation, because it's embedded in the economy, and the Fed policy is more addressing the demand side of the equation. The Fed wants to curtail demand even to the point of recession to hope to slow the economy enough to get inflation out. But what it's not addressing is the supply side. And that brings us back to the last time we battled this kind of inflation, coming out of the 70s into the 80s, when interest rates were through the roof. I remember the Treasury bill rate that we're talking about at 5% now, and that was at zero, being at 16 or 17%, 18% that time, back in 1980, whatever the year was. Yeah. During the Volcker years, the Paul Volcker years, who the Fed chairman then, who battled inflation. But inflation wasn't kicked out of the economy for the long term until there was a massive restructuring of the underlying situation in I'm going to say America, but let's say the Western economies. So it really took, and this is a nonpartisan statement, I'm not talking about supply side or trickle-down economics here. I'm talking about the real change came not just from high interest rates from the Fed Volcker situation in the early 80s, but it also came from the Reagan restructuring of the tax structure and producing incentives for corporations to increase productivity. And when they increase productivity, they're addressing the supply side. Again, the blog addresses this in detail. So when corporations have an incentive to increase productivity, it helps get rid of inflation. It helps to provide the other half of the equation to get rid of a long-term inflation. So rising interest rates and high interest rates will only do part of the job. It's possible that if nothing else happens here, there's no fiscal reform or regulatory reform or tax reform in the respect that I'm talking about here, it's possible that that doesn't happen. Inflation cools a little here and then comes back and cools and comes back, and we're dealing with this problem 6 months, 12 months, 18 months from now, and people are going, wait a minute, when is this going to leave? It's going to take an increase in business productivity to solve the rest of the long-term equation and to get embedded inflation, and it is embedded right now, out of the economy.
And that's an excellent point, and thank you very much for making that, because it's clarifying a lot of things that need to happen. But the biggest one, that what you said, is a restructuring, the restructuring of our tax codes. And as soon as you mentioned it, I was like, yes, I remember when that happened. I remember when it was announced. I was on the Pacific Exchange, and suddenly all you heard was buy, buy, buy. Everything. They were buying calls. They just buying stock. They were just, and the reason is because they were changing how we were going to be taxed. And you're right. It did open up a lot of doors, but that didn't happen immediately after 1981, after interest rates reached their peak and we did start to come down. That I'm trying to remember exactly when that took place. And for some reason, what's coming into my head is 83, 84, 85, somewhere in that period is when it actually was put together and announced. And so it would have been actually Reagan's second term.
I think it was 1986, the Tax Reform Act of 1986.
Thank you. I knew it was there somewhere. And it wasn't in his first term, it was in his second term. So when people are trying to look, well, when is this all going to come to an end? If indeed our tax structures need to be revamped yet again to produce the situation, to produce the monetary situation that we need economically, to kind of bring inflation back in, to kind of set it up so we can get the interest rates back to a level that everybody's going to be happy with, et cetera, et cetera. If we're just starting that process now, and it's 2022, and we're really not showing any evidence of anything really happening by 2023, a year into this, so are we really looking at the possibility is 2025, 2026?
Right, and there's one good hope, I think, and that's AI, artificial intelligence. If that can be applied, I want to say appropriately, that's probably the wrong word. If that can be applied effectively, then there could be a surge in business productivity along the lines of exactly what I'm talking about here. So the Fed raises rates as it has been. That helps slow demand, but really to get it out of the economy for the long term and for it not to be embedded, we need something else. And that's increase in business productivity, whether it's regulatory reform, tax reform, whatever, as long as there's incentives for companies to increase productivity, that should happen. And, that's complicated by some of what you and I have been talking about, Michael. I mean, the onshoring is inflationary. If you think about it, the offshoring during deglobalization through lower manufacturing costs, lower labor costs offshore is deflationary. That's right. Another reason we didn't have inflation for so long. But bringing that back onshore, like companies want to do now in this new version of normal again, with a Cold War and so forth, like we've been talking about, that's inflationary because the United States has higher labor costs, has higher manufacturing costs than when manufacturing is done offshore. So that's an extra factor to battle here with respect to how we're going to get embedded inflation out of the economy.
Right.
Not just rising rates or high rates, even if they don't keep rising, but some sort of increase in productivity and something to seriously combat what we're talking about here, the inflationary tendency of onshoring, because that trend toward deglobalization and onshoring will accelerate if the geopolitical situation gets worse. Tensions with China are getting worse.
Yes.
The chance of their invading Taiwan, I think, it may be getting worse, or at least it's there for everyone to see. Russia's dug in for a long war. I mean, who knows how long that's going to last or what else is going to happen there. North Korea is making noises. There's geopolitical tensions everywhere. And the risk to corporations of getting their supplies cut off again, like they did for COVID and like whatever else has been happening, is high.
Right.
So the tendency to onshore is inflationary. The Fed raising rates is deflationary. That hasn't reached equilibrium yet. That has not balanced out, and it's going to need to, and that's going to take a while. This is going to take a while to get embedded inflation out of this economy.
I agree, and I think it's going to take. I'm watching our watch. We both are, folks. We are watching because we tend to talk and we just keep talking. So we both set a little stopwatch. So please forgive us.
Mine just went off. I don't know about yours, but
I still got about 2 minutes, less than 2 minutes, and then mine will go off. I think it's an excellent point. Now, what I'm going to do is first of all, folks, please do defendingyourmoney.com. Read this blog post. It's going to give a lot of understanding to what needs to happen, what's still going to happen versus what we're seeing. And that's the whole point of why we got together today to discuss it. But when we're talking about how long, I think of what I want to bring in, this is where I turn to Elliott. And when I'm looking at that, as we discussed in previous blog posts, that what we're in is a corrective phase that's really covering at least the last 13 years, if not a little bit longer. So, and by the way, the NASDAQ, it was a crash, but it was a crash really only in the NASDAQ, 2000, 2003. That was pretty much held to the NASDAQ because it was the dot-com bust. Because if you look at the NASDAQ chart and then you go to the real financial collapse, it's this versus that. This being the financial collapse, this being 2001 to 2003. So in any case, when I just put it out and I put it on a time cycle and I just put it on any type of a cycle, it truly is now, I think right now we're getting into a good decline. We should be able to start a decent decline, but that's really only going to take us back maybe to S&P 3000, maybe a little bit below. And that's only a primary A.
I think you just gave everyone a heart attack.
I may just, but I think it's like keep it in the big picture, folks. It's really won't be a heart attack, because go back to where we were in March of 2020. Go back to where we were in 2009, where the S&P hit 667. That's a real number, and it's 13 years ago. So again, when people say, "Oh, it'll never go back there," it's like, you may think that it'll never go back there, but it may not have a choice. Because if everything were to come in, and we live in a perfect world, to get all of this into motion and to be presented to where we can start over again, where we can have an economic expansion, folks, we can't do it. We can't do it from where we are. We have to fix a lot of problems. And indeed, if it is that we've got to now bring onshore versus offshore, it's going to be hiring our own people. And yes, that is inflationary. So yes, that will give the Fed a little bit of an extra headache. But I got to tell you, in my heart of hearts, that's a headache I think I can deal with. I think because as a country, I think we become stronger. Instead of being this great exporter, we will be able to produce it, importer, we'll be able to produce it here and reap our own rewards out of that. But I do feel that it is necessary. I do think it's time to bring things home as the global situation changes and gets itself settled in. I'm not sure we can really go on because the other thing we're trying to do, folks, is trying to keep it down to a decent number in terms of time. So I am going to kind of let's pull it together here. And so any closing thoughts that you might want to put in other than please go to defendingyourmoney.com and pull up this blog report, read it, digest it. If you have questions, respond, back. So, Dan.
Right. I think the thing is to not lose sight of the big picture, and the big picture is changing. So it's actually kind of easy to lose sight of it because people may feel a little bit blitzed by everything that's going on here, all the changes and where are they going, what's going to happen. No one really knows. What we're seeing, though, is the shift in trend towards more risk management of corporations in the United States and wanting to onshore. So the key is not to lose sight of the big picture. And the key also is to be open to what's happening here, because what we have is a situation in which a market, let's say the stock market, that backs and fills normally is a healthy market. It's getting rid of the excesses and heading higher in a trend as it goes. But a market that's manipulated, and I'm sorry, the Fed super manipulated the market starting in 08, maybe even before that, but let's say the 08-09 crash. They super manipulated interest rates. They bought bonds, mortgage-backed securities. There was talk of them buying ETFs, stocks, whatever, and the Fed put, supporting the market when it drops. Yeah. That caused people to think, wow, maybe there's not a lot of risk here. Maybe I can buy and the Fed will support the market. And it was, but the Fed's pulling that support from the market for the most part. And also, you've got to ask yourself, can the Fed really support the market during collapses? So the COVID lockdown, the COVID collapse, and I hear the government is shutting down the market in 2020 during the COVID lockdown, and it still crashed. So the Fed can't really stop it, if you think about it. There's a huge moral hazard in what the Fed's doing, in my opinion, and the opinion of many others.
Right.
There's a lot of unintended consequences. When you manipulate a market, that healthy backing and filling I just spoke of is now exaggerating. The market goes up higher and it drops more, and it goes up higher, and it's a much more volatile, sine wave, so to speak, as it's going up and down. And that means more volatility, more risk. And so I think the thing is, don't lose sight of the big picture. Don't lose sight of that. Be open to what might happen here, because no one really knows. I mean, you and I are talking about it. We've been around a long time, but we still don't know.
No,
so the main thing is to keep focused on the longer term and don't get too hung up on the real short term stuff like 0DTE options. I'm not saying that I'm making a decision as to whether you should trade them or not, but keep in mind what they are. Yeah. And keep in mind of what may happen going forward that is beyond that real short-term stuff.
Thank you. I think that's great. Something else that I'm going to add right now, and this is something that, again, Dan and I have talked about, and now we've agreed that, yep, we're going to do it. And we're trying to put a date on it, and not necessarily we've got a firm date, but we're looking at the beginning of March to the mid-March. And that is Dan and I are going to be combining our analysis, combining how we view things, combining what we bring to the table, and revamping and expanding the logical signals trade room. And so there'll be more details on that. But what's really going to be happening is that you're going to be getting a lot more information to whether even if you're a day trader, even if you're a scalper, if you're a swing trader, or you're a position trader, there's going to be a lot of information that's going to be revealed and given that's going to help traders put on the positions that they need to have on at that particular moment, and just help get through all of this. So again, what I have become, from being a retired market maker and options market maker, I'm now a retiree who's turned into a day trader. And while it really does provide a lot of no angst, no anxiousness, no stress on overnight risk, as I don't carry positions. And so but there are a lot of things to do during the day. There's a lot of things in them, and we're going to be adding them. So if you have an interest, please tell us. And you can do that by dropping a line to Dan at info@defendingyourmoney.com. If you have any questions for Dan, info@defendingyourmoney.com. Also, adding into this mix that I do want to get out there, because this is available now. You can do this now, either with myself or with Dan, and that is coaching. Coaching at times is like a very, very valuable tool to a trader who's trying to get over a particular problem, who's trying to get a better understanding of what's happening or how they should be putting these trades on. And sometimes all you need is a little coaching. And so Dan and I both provide that coaching. And if you have an interest in coaching with Dan, contact him, info@defendingyourmoney.com. He will respond. It's something we both enjoy doing, answering questions from people who want to know. And then for me, you can contact me at michael@mjf1partners.com. And again, it's the number one. So mjf1partners.com. I'm going to wrap it up right here. Dan, thank you again. I so appreciate it. We came in with this intention, trying to not make this as long as we can, but we achieved that, but there is just so much more to say. So I'm afraid that Dan and I are going to have to come up with a different type of a situation. That might be, we're going to do more of these during the week. We're going to have to just start putting this out, because I find the information very useful, and we're getting very good responses from people. So again, thank you very much. And we will be talking. And for the rest, have a great balance, because this is Monday. It is President's Day. It's February the 20th. It'll be posted ASAP. But at least you know it's recorded on Monday, February the 20th. Have a great balance of the day, and we'll be back.